Hey there, today's market update video is going to be a real treat. I'm actually going to let you behind the scenes and give you some access to one of our portfolio managers that we work with for the fixed income or the bond side of our client portfolios. I haven't done this in the past. This is the first time for me, so I'd love your feedback. Let me know what you think of this interview and what we can ask or do differently moving forward in the future. Let me also give you the three things you're going to learn today. Number one, you're going to learn about this yield curve inversion that we had happen this last week. If you guys were paying attention to the news, you probably heard a lot about it. And so what does it really mean to you, to your investments, and to the global economy? Number two, what is going on with the global economy? Where are we? And is America still the best place to be investing from a stock perspective rather than international markets or emerging markets? And number three, what's going on with the China trade war, and what does that mean to you, your future, to your portfolio for the short term? So with that, let me switch gears just a little bit and give you a little background on Bill. Bill Zox has worked with Damond Hill Capital Management for almost 20 years now. He's a real sharp guy. He is an attorney as well. He has a Juris Doctorate from Ohio State University and a master's in taxation in law and taxation from the University of Florida. And so before joining Damond Hill, he worked at a law firm for about 7 years, a little over 7 years, and became a partner while he was there. So he's a real sharp guy. He's professionally accomplished. He's a great portfolio manager, and he's just a good all-around family man. I really enjoyed my interview with him today, and I'm excited to be able to introduce him to you too and let you see some of the people that we end up working with on a day-to-day basis. So with that, let's jump right into the call, and I hope you enjoy it. Let me know what you think. Thanks. Hey everybody, welcome to our call today. I've got Bill Zox here from Damond Hill Capital Management. He's one of the portfolio managers for some of the portfolio that we manage for our private clients here at Epic Trust Investment Advisors. And I'm really excited to have him on the call today because right now is a really important time in our market. And more importantly, this week we saw one of our biggest recession indicators that we keep a pretty close eye on, which is the 2-year versus the 10-year yield curve. Ended up inverting for just a short period. We had 1 day of inversion this week, and that sent the news on a craze. We got a couple of great hours worth of news out of that this week. And so what I wanted to do for the folks that we're working with now is just to let you know what that really means to you in your portfolio, whether or not you should be concerned, and just get some on-the-ground feedback from folks who are in the debt market every day doing this as a living, and some of them doing it for you, or at least some of your portfolio is being managed by Bill here. So we're really excited to have you here, and we're really pumped to have Bill on the call. And thank you, Bill, for joining us today. It's been fun to get to know you over the last little while that we've been working with you guys. And so why don't we dive right into our first question here, and that is, as far as the yield curve, what happened this week? Why did it happen, and what does that mean for our investors or for the general marketplace as a whole?
Yeah, I mean, Wednesday was the 15 minutes of fame for the yield curve. I came home and my kids were asking me about the shape of the yield curve, which is probably going to be the only day in my entire career where that will happen. But
will they ask you about work?
Well, were they asking about the shape of the yield curve in particular? Maybe, the market crashed or something, that I can understand, but it was pretty surprising when you come home and everyone's talking about the yield curve.
Right on.
One of my colleagues said he was listening to MSNBC, not CNBC, MSNBC, and they were explaining what an inverted yield curve meant on Wednesday. So that was a pretty big day for the yield curve for sure. And that inversion where the 2-year yield was modestly higher for the 10-year yield just for a minute on Wednesday, it is a very significant moment in the markets, but it becomes a lot more significant if that inversion is sustained for about 3 months. That's really the work that we've done. If that's sustained for 3 months where the 2-year yield is higher than the 10-year yield, now in every case where that has happened, recession has followed. Sometimes it was 6 months later, sometimes it was 4 years later. But that is a very significant indicator of a recession, but especially when that inversion is sustained for 3 months. And in this case, it was only sustained for a few minutes. And right now, the 2-year yield is once again modestly lower than the 10-year yield.
Right. We've got about a 4 basis point difference this morning as we're talking right now, right?
Right.
Yeah, that's the exact same analysis actually we've done as well. And if we go back to 2006, for example, in January of 2006, what we've seen is that we saw a pretty dramatic drop below the yield curve line, or we had an inversion of the yield curve for less than a month, and then we peeled right back out of it. And then a few months later, we peeled down again, came right back out, and then that third drop below the yield curve is where it was sustained long enough. And then about, just shy of 2 years later, or a year and a half later, I guess, is when the 2008 recession started.
Right.
So, and this is what we've been talking about with our clients for a long time too, is that one day is not a big difference, right? It's not a big deal. One day is not a problem. It's not going to totally change the course of the economy, because bonds and yield curves or interest rates take a long time to work their way through the market, right? And so because of that, I guess you mentioned just a second ago, anywhere from 2 to 4 years on a wait time before the recession hits.
Not always that long, but on occasions it has taken that long for that sustained yield curve inversion to then lead to the recession. Sometimes it is as long as 4 years. Right.
So bottom line is, this is not a warning signal yet, not a major warning signal. It is the beginning of a potential issue, but we have to have this sustained for a while.
That's right. And I think the other thing that's interesting about the yield curve is people say, yeah, but the economic data is fairly strong in the U.S., especially with the consumer, which is 70% plus of our economy is based on the consumer, and the consumer is doing quite well right now. But I think in this case, what the yield curve is signaling is nothing about the current economic conditions in the U.S. It's signaling an issue with government policies around the world. Not just in the U.S., but all around the world. We have all of these issues: tariffs, currency wars, Brexit.
Right.
What's going on in Asia right now? Germany is on the brink of recession and does not have probably appropriate fiscal policy, but today the market is doing quite well because there is some indication that Germany might engage in some fiscal stimulus, which would be very appropriate for their economy right now. So I think a lot of this is policy driven. It's markets telling policymakers, we want different policy right now. We want policy that is more supportive of global growth.
Right. And that's what's interesting too, that I've seen from where the dollars are going, right? And this is what's forcing our yield curve to be inverted in the first place, is we've got all those other countries out there that are having their own financial issues. And so they're bringing their money to the U.S. and buying down our rates, which is forcing our yield curve down because they have negative interest rates right now, right? So this is not a warning sign that our economy is in trouble. It's actually more of a warning sign. If I'm hearing you right, you're saying this is more of a warning sign of other countries around the globe being in financial trouble. So they're coming here as the safe haven, and that means it's buying our rates down. Is that what I understand to be correct?
I think that's right. I mean, I think we are in a stronger position than just about any other major economy around the globe. I mean, I think that is clearly the case. But these policies will, if they're not changed, at least at the margin, these policies will eventually have an impact in the U.S. If every other major country is in recession, that will clearly have an impact on the U.S. It will hurt us less than everyone else, but it will still have an impact on us.
Right on. So I guess to wrap this portion of our chat up about the yield curve, bottom line is, right now is not a huge time to be concerned about a recession in the U.S. based on the yield curve, because we have all kinds of other economic data that's still very strong.
Right, and also market data, the level of stock prices, and in the high yield market, what we will talk about shortly, the additional yield that you get from investing in corporate bonds versus government bonds is not signaling that recession is imminent. So those two factors, stocks and high yield bonds, would suggest that the economy is much stronger than for instance, it was even late last year. The fears were even greater in December than they are today if you look at stocks and high yield bonds.
Right on. You know, we could probably end our call right now and a lot of people would be happy, but please don't leave. We have a lot more good stuff to talk about that I think will go towards the future and help you guys make some good decisions. But that is exactly how we feel. That's how we feel about money in our firm and the way that our investment team is viewing the economy right now too. So I'm happy to hear that that's being confirmed by someone that manages hundreds of millions of dollars in their bond portfolio. We're really happy about that. So thank you for confirming our own confidence in the market. Now that being said though, so for the last year or so, we've been talking to our clients and specifically towards our baby boomers about, well, let me back that question up a little bit. So I've been saying for several years now that baby boomers are more likely to see negative interest rates during their lifetime than they are to see like an 8% mortgage again, which isn't that high, but from where we are today, that seems like a lot. But they remember back in the 80s when mortgages were 17, 18%. But I really genuinely believe that we're going to see negative interest rates before we see an 8% mortgage. So first off, can you help explain what negative interest rates really mean to our economy? And then I've got two other follow-up questions for that too.
Sure. I'm 52 years old, so I'm not a baby boomer, but
You're too young for that.
I think my oldest sibling is a baby boomer, but my first mortgage was in 1993, and it was 7.75% for a 30-year fixed mortgage. And I remember everyone thought that you'll never see anything that low again. You've got to lock that. And now it's funny that we're talking about, will we ever see 8% again? And my answer to that particular question would be, it's going to be a long, long time. Probably not in my lifetime will we see an 8% mortgage. I think we're that far away. But now what you're talking about is on the other extreme, are we going to see negative interest rates in the U.S.? And I think that's much more likely than we will see an 8% mortgage. But I don't think it's necessarily the most likely scenario in the U.S. I think one thing that we're learning is that monetary policy has been pushed to its limits, and it's not that effective anymore. And negative rates are not that effective in stimulating economies. Certain economies like Germany and Japan have taken rates pretty far negative. I mean, this morning, the German 10-year yield at one point was minus 0.72%. So, that's pretty negative, but it's not working. And I think that we're starting to figure that out. Policymakers are starting to figure that out. They don't know what to do. So we're getting some of this because they don't know what else to do, and central banks are stepping in because nobody else is doing anything to address our problems. But I think we're getting near the end of that. In the U.S., a year ago, we thought that we might be able to normalize interest rates in the U.S. as the Federal Reserve was moving up the Fed funds rate to, at the end of the year, 2.5%. It looks like that's not going to be successful, and now the Federal Reserve is going the other way, in part because of what's happening in other countries. So I don't think we're going to normalize rates, but I also don't think that the U.S. we would be the last country to have negative interest rates, and I don't think that's a likely scenario, but much more likely than 8% mortgage anytime in the foreseeable future.
Right. I think that's wild too, just because there's so much bad news that has to happen for us to be the safest place, that other countries are buying our rate down so much that they're willing to pay the United States or our Federal Reserve System in order to keep their cash here. And that's what they're doing in Germany right now, right? To the tune of 0.75% and 1% a year. They would rather pay to keep their money in bonds that they have to pay for to keep their cash safe than invest it in the stock market in those countries or do other types of investments or other bonds. That's wild. That's what a negative interest rate is, right? And what that means to our investors or our economy is that, and I'm actually really happy that you've shared that your perspective with us, that you don't think we'll actually get there because we're not seeing it work in other countries. And actually, Germany's probably a great example. It's the perfect example. They have the most negative interest rate and most negative debt in the world, and their country's still going into a recession. And so it probably won't work here. So that's super interesting to hear. I'm glad you shared that with me. So how could our investors, or how could folks prepare for this environment where we could have ultra low rates, if not negative? What if they're ultra low for a long period of time? Where do they go to get a yield? Where do they go to get some kind of a return on their safer investments that's not in the stock market?
Right. Well, you do have to bear credit risk to earn additional yield. When, that's part of why central banks are bringing rates down so low, is they want to incentivize investors to take on more risk, which is good for the economy. And you have to do that, but you have to do that in a very prudent fashion. So you don't want to just go out and reach for yield wherever you can find it because government bond yields are so low, but it does incentivize you to look for prudent places to bear credit risk to earn an acceptable return.
Right on. That reminds me of a really interesting conversation I had with a client a couple of years ago. He was investing inside of his 401k plan in these really high yielding stocks. And so he was buying like REITs and things like that. And they were paying out like 12 or 13 or 14% interest. And he was getting this really high interest rate. But every time they paid their dividend out, his stock price would fall. And so he got paid like 12 or 15%, but he lost 20% in his stock price, and he went back by 5%. And after a year or so, he met with me. He's like, Jeff, why aren't I making any money? And he didn't realize that he was losing more in the stock price because of the credit risk in these companies. They were paying out so much money, they actually couldn't afford to do it. And they were just paying it out to be able to get people to buy their stock. And so there's definitely a happy medium between that perspective and buying government credit, which is paying 1 or 2% right now, depending on how far out you want to go. We got to find a happy medium in the middle. So that probably brings us to the high yield space, honestly, right? And so how do we do that? What's a strategy, or how do you guys do it? Because that's where, full disclosure, Damond Hill and Bill actually helps manage some of our clients' money. And we love that. They're doing a great job for us. I can't go into a whole lot more detail than that for compliance reasons for everybody, but just so you know, they manage money for us. And here's the reason why. We're going to let Bill share a little bit about what makes them different and why we use the strategy that we're using, because we know we can't be on this end of the spectrum. We know we can't just buy government debt and get a 1 to 2% return after the management fee. And we know we can't be on the other end and just chase yield for several percentage points imprudently, or just being too reckless with the investments. So where's that happy medium in the middle somewhere, and preferably on this end of the dial, right? And that's where Bill and his team come into play for you guys, and where we would recommend for our clients to be. So Bill, take it away. What do we do in the high yield space? What's a strategy we can follow that makes sense to be in the middle of that dial somewhere?
Sure. There's a couple things, and I'll start with having a long-term time horizon in the high yield market is very helpful, because if the market is overvalued, but we measure our performance over rolling 5-year periods, we don't have any incentive to chase an overvalued market because we're trying to keep up quarter by quarter. Mm-hmm. So a long-term time horizon is very important. And in all of investing, there's a time to make money and there's a time to not lose money, or, where you should be more emphasizing either making money because the environment is very attractive, or you should emphasize more not losing money. And it's important to know what environment you're in the high yield market, because we have these contractual cash flows. You have bonds that pay you a certain amount of interest, and then on a certain date, all the principal is owed to you. It's very apparent which environment we're in based on the additional yield that you can earn by investing in these corporate bonds. So, but if you're chasing an overvalued market, you're still going to be trying to make money, even if the environment dictates that you should be trying to not lose it.
Right.
That's one thing, that long-term time horizon is very important. Another very important distinction between our approach and the approach of many of our peers is many of our peers start with a high yield benchmark or an index that tracks high yield bonds. And the largest bond in that index is the company that's borrowed the most money, which is kind of perverse. If you were a banker, you would not go out looking for the company that had borrowed the most money. You would go out looking for the company that was the best credit risk, and that's who you want to lend money to. So we do not approach it that way. We do not say that company A has borrowed $40 billion. It's the largest weighting in the high yield benchmark. Say it's 2.5% of the high yield benchmark. We hate that company. They've borrowed way too much money, but we're measured against that benchmark. So maybe we hate it. We're going to own 2% instead of 2.5%. We're just going to underweight it. That's not our approach. If we think that that company has borrowed too much money and it's too complicated, we're not going to waste our time on that at all. On the other hand, if we find a company that is a tiny part of that benchmark, maybe it's way less than 1/10 of 1% of that benchmark, but we think that it's a fantastic credit that has not borrowed much money at all, and the yield or the income that we get for lending to that company is attractive, we're going to make that a meaningful position. So it's a very common sense approach to investing or lending money, but it's surprisingly uncommon in the institutional money management business. So those are two very important points. And I guess the third I would highlight is, why doesn't everyone approach it the way we do? Another point is that you can only be so big if you do things the way we do. If you're huge and still growing in terms of the amount of assets that you manage, that company that has borrowed $40 billion, you're going to have to own some of that because you have so much money to put to work. We're very careful about how much money we manage, and we will close our strategies to new investors before we get to the point where we cannot take a meaningful position in that company that might be 1/10 of 1% or less of the benchmark.
Great. I'm going to actually come back to the high points here too, because I think they're worth repeating for folks. And what I heard, and please correct me if I didn't actually get these come through okay, but know your market environment and where you are right now was the big one. And to drive that a little deeper, it's more of knowing when not losing a bunch of money is better than making a good return. Number two was, don't just chase the returns just for the sake of being in the game, right? And then the third one was, take a more common sense approach to which debt you're buying, just because, and this is actually something I love about you guys, and one reason we pick you and we have you working for us is because we have managers on all those spectrums. We have the managers that are taking the index approach and we're getting everything, but we're also getting potentially too big of a debt picture or an overweighted debt picture in some of those funds. And then we've got you guys on the other end of the spectrum where you're being very methodical, very practical about which debt we're buying, because we want to buy debt that makes sense, not just debt that's there because it's there. And I will share with everybody over the last several months that Damond Hill's approach, their strategy, has been a superior strategy in this down market that we've been in, because the Fidelities of the world and the Vanguards of the world, which we own, we have some of that stuff in our portfolio, they're getting hammered more because of that structure or that issue in the debt and credit environment that you just mentioned in your last point. And we're grateful you guys are in our portfolio because of that reason. Because, when they come back around and the market comes back around, they're probably going to revalue faster than you guys. But I'm not worried about that, because I'd rather have less money gone knowing when not to lose money is more important than making good returns or trying to knock it out of the park and get a home run. And I like the complementing strategy that you guys bring to the table for that reason. And that's honestly, everybody that's watching this, that's why we like Damond Hill. That's one of the reasons they're in our portfolio, and they have a major position among the 6 bond managers we use. They're one of them because of this right here, because of their common sense approach. And what I've learned is that if you do things that make sense, it's funny how it works out, but it usually just works out.
Right.
So we're happy that that's the case. So we'll wrap up here in the next couple of minutes, but we'll go through a couple rapid fire questions. How's that sound, Bill?
Sure.
All right. So why would you buy high yield bonds right now rather than buying other corporate debt?
Well, there's a lot of interest rate risk in the market right now with rates as low as they are. So I prefer credit risk to interest rate risk right now.
Okay, cool. Any tips for investors on how they can recession-proof their portfolio today?
You just want to avoid the most aggressive strategies right now. We are late cycle. The cycle could still be extended for some time, but we are clearly late cycle. You don't want to be in the most aggressive strategies right now.
All right, sounds good. If this was your mom and dad's money, would you do anything different than we just talked about?
No, this is my mom and dad's money. With
Love it.
they're living off their portfolio. They spend about 4% a year of their portfolio, and this is over half is in our high yield strategies.
That's great. And we're just super grateful to have you on the call today, Bill. Thanks so much for being able to take some time out of your busy day. You might see this gentleman on TV, everybody. If you do, wave to him, say, you know that guy, because it's been super fun to have you. You've been great. Really appreciate you being out with us today.
Enjoyed it. Yeah, my pleasure.